For the past several weeks, we've been bringing viewers a weekly segment called Money Minute. Again, talking about trying to save you some money here and make the best use of your funds. Now, this features Steve Sexton, president of Sexton Advisory Group, and Steve's segments have been so helpful in providing very valuable advice about proper financial planning. This week, Steve talks about how to not follow the herd when it comes to investing.
Thanks and hello everybody. This is Steve Sexton with this week's Money Minute. Last week we talked about the bond bubble and people moving in a herd and going in the wrong direction with the market. Many major advisors besides myself advocate people from moving from a bond portfolio because it's hit its bubble to a dividend paying or a value portfolio. When you're looking at a value portfolio and picking stocks inside there, you want to look at value, safety, and timing. Now value. Now analysts will determine a book value for a specific stock. It might be $10. And then the stock price might be $18. That means it's well overvalued. And a lot of people, they'll buy a stock on its way up, and when it's well overvalued, all the institutions sell, which means they find their stock dropping down. Now, when you look at value, you want a book value to be high, so it might be $50 a share, but the stock price is at 20, so you got 30 points to move, so there's a lot of value in that stock. Next, you want to look at safety. Is that company going to be around? Do they have good management? Is the fundamentals in place, meaning is it growing at 17% per quarter and has done so for the last 5 quarters? If they are, probably got a good safe stock there. Next is timing. You know what? I can buy 1,000 shares of something and so can you. But you know what? If the institutions, meaning the pension fund managers, the money managers, the hedge fund managers aren't buying a specific stock, it's not going to go too far. If the institutions are, and you can see that from the timing, guess what? You're going to probably get some amplified gains on top of that. Now add that on to a dividend. Now for example, we have a oil stock that pays a 7.25 dividend. It has a book value of 170, stock price of 113, so you can see there's a lot of value in there, and the institutions like them. So regardless of what happens, we're going to see a stock that's going to grow at a dividend of 7.25, and they got a lot of value to grow, plus the institution's going to drive the stock price, which is going to work out very well for whoever owns that stock. Now that's it for today. If you have questions about the value, safety, and timing when developing a portfolio or a dividend portfolio, you can always go to our website and ask questions or give us a ring. Now remember, smart financial decisions do impact the quality of your life.